lying in the Middle East. Inflation is scorching hot, and the Federal Reserve is, openly threatening to hike interest rates.
Yeah.
So what did the market actually do today? It completely ignored all of it. It just bought the dip and pushed tech indices to the absolute limit. Welcome to Market Recap. I'm Daniel.
And I'm Mira.
And today, Thursday, May 28, 2026, was basically a masterclass in market cognitive dissonance.
Oh, absolutely.
Right. So let's start with the closing reality check. The S&P 500 closed at 7,563.63, and the Nasdaq just surged to 30,321.25.
Which is wild.
It is. And the 10-year Treasury yield actually cooled off slightly to 4.455%. Meanwhile, WTI crude oil experienced this severe overnight volatility. It plunged down to $88.24 before, bouncing back to settle at $88.70.
Right. And gold.
Gold acted as like the only traditional safe haven today. It exploded to close at $4,541.80.
It was honestly a day where the underlying data and the price action just seemed to exist in, well, two entirely different universes.
Exactly. So in today's deep dive, we're going to unpack the pre-market data barrage that kind of set this whole chaotic tone.
Mm-hmm.
Then we'll break down the intraday tug of war between the physical geopolitical escalation in the Middle East and this massive, seemingly unstoppable AI infrastructure arms race.
Yeah, that's the big one.
Right. And finally, we'll look at retail consumer health to see what's actually happening beneath the tech-heavy surface.
And before we get into the weeds, just a quick reminder for you listening. This deep dive is strictly for market context and discussion. It is not personal investment advice or an investment recommendation.
Perfect. Let's move to our first session. Session 1, what set the stage before the U.S. session?
Right. So the initial shockwave really came from this massive data release right at 8:30 a.m. Eastern time. Mm-hmm. This was well before the opening bell.
Yeah, the inflation data.
Exactly. The April PCE price index hit the wire at 3.8% year over year. And the core reading, which strips out food and energy, was stubbornly elevated at 3.28%.
That's high.
It is. It means consumers are still actively absorbing price hikes across the board. And simultaneously, the Q1 GDP second estimate was revised downward to 1.6%.
Wow.
So mechanically, you have this headline scenario where economic growth is cooling, but price pressures are accelerating.
But, the internal mechanisms of that 8:30 a.m. data dump told a completely different story,
Wow.
Specifically with durable goods.
Right.
Durable goods orders didn't just beat expectations, they surged 7.9% against a forecast of just 4%.
Which is a huge beat.
Massive. And if the broader economy is genuinely cooling off, heavy corporate capital expenditure should be like the very first thing executives cut.
Absolutely.
Instead, they're deploying capital aggressively. It really raises the question of whether this early morning panic was just a product of relying on stale macro data versus real-time pricing.
Oh, that's a great point.
Right. Executives aren't looking at a backward-looking GDP print to run their businesses. They're seeing real-time input costs and front-running future inflation by, buying equipment now.
Yeah, that divergence is so critical. The GDP data basically reflects the weather a quarter ago, while durable goods orders show us that corporations are actively building arcs for tomorrow.
Building arcs, I like that.
Thanks. And speaking of volatile real-time pricing, we also had this massive narrative carrying over from Wednesday regarding global energy transit.
The oil plunge.
Yeah. Crude oil had plunged overnight based on rumors of a 60-day truce. There was this emerging memorandum of understanding, or MOU, between the U.S. and Iran regarding the Strait of Hormuz.
Right, but an MOU is literally just paper. And the physical reality of the supply chain is infinitely more complicated than that.
Very true.
U.S. Treasury Secretary Bessent kind of threw a wrench into that optimism before the market even opened. He explicitly warned Oman and global corporations against paying transit tolls to Iran.
Right.
So mechanically, he forced maritime shipping companies into this impossible corner.
Yeah, it's a terrible spot to be in.
It is. They either defy the U.S. Treasury and violate sanctions by paying the tolls, or they refuse to pay and risk their physical tankers being targeted by the IRGC and, one of the most critical maritime choke points on the planet.
Which meant investors walked into the U.S. session juggling sticky inflation, contradictory growth data, and the realization that the overnight hope for cheap, unimpeded oil transit was incredibly fragile.
Exactly. So that wraps up our morning setup. We'll take a quick break, and when we come back, we'll see how U.S. trading hours completely scrambled that morning narrative.
All right, we're back. Session 2. What moved markets during U.S. trading hours?
So if the morning was driven by spreadsheets and data, the afternoon was driven by rhetoric and, well, missiles. Literally. The core session was hijacked by a barrage of hawkish commentary from Federal Reserve officials. This peaked around 1:12 p.m. ET. Fed's Musalem was the most aggressive.
He's very vocal today.
He was. He warned that current monetary policy might actually be operating below the long-run neutral rate. And he explicitly stated that the possibility of a rate increase is greater than zero.
We really have to unpack the mechanics of that neutral rate comment, Daniel, because it's explosive.
Yeah, go ahead.
So the neutral rate is the theoretical baseline, where the Fed is neither stimulating nor restricting the economy. If Musalem believes the neutral rate has fundamentally shifted higher, then the Fed's current target rate, which feels historically high to us, isn't actually restrictive at all.
Right.
It means they're accidentally stepping on the gas when they think they're hitting the brakes.
And that directly threatens central bank credibility as an inflation anchor. If the market senses that the Fed doesn't even know where the brakes are, inflation expectations can unmoor entirely.
Exactly.
Normally, the mere threat of the Fed fighting to regain that credibility drives up bond yields. And that leads to rising discount rates as financial gravity.
Which is usually devastating for equities.
Right. As that gravity gets heavier, growth stocks with valuations based on earnings a decade from now usually crash back to earth.
But tech valuations defied physics entirely today.
They really did.
And that resilience is even more absurd when you look at the physical reality unfolding simultaneously. By 3:53 p.m. ET, the theoretical risks in the Strait of Hormuz became kinetic.
Yeah.
Reports hit the wire that the Islamic Revolutionary Guard Corps attacked 4 ships, including U.S. vessels, and launched missiles.
This is where we have to, challenge how algorithms and traders were pricing the Middle East overnight. The market saw a headline about a draft MOU and immediately priced in a peaceful resolution.
Yeah, they jumped the gun.
Totally. But treating geopolitical conflict like a predictable weather event is a fundamental misread of the situation. We have to analyze this through the lens of geopolitical brinkmanship as game theory leverage.
Right.
Firing missiles while a truce is being negotiated isn't necessarily a breakdown of the talks. From the IRGC's perspective, it's a calculated tactic to show strength and extract better financial terms at the table.
It's the classic error of markets pricing ahead of physical reality. The oil market basically celebrated a touchdown while the football was still floating in the air.
That's a great analogy.
Thanks. At 3:53 p.m., the physical reality showed that the ball was highly likely to be intercepted. Yet the broader equity market, and specifically the Nasdaq, completely ignored the missiles and the Fed.
They ignored it because institutional capital found this massive, glowing safe haven in mega-cap tech.
Unbelievable.
During U.S. trading hours, an absolute avalanche of capital was deployed into artificial intelligence.
Yeah.
Around 2:13 p.m. ET, reports confirmed that Anthropic raised $65 billion at a staggering $965 billion valuation. Yeah, and shortly after, Amazon struck a $6 billion deal with Snowflake, and Microsoft secured a $9.7 billion Pentagon contract.
We're talking about nearly $1 trillion valuation for an AI lab minted right in the middle of a chaotic trading day. It shows that institutional portfolio managers are viewing AI capex as a cycle-agnostic arms race. The hyperscalers are not looking at Musalem's neutral rate comments or PCE data to decide whether to buy more servers. They are locked in an existential battle for computing dominance. If they stop spending billions, they lose the future.
But we have to look at the structural risk this creates for the index. What we are really witnessing is tech capex masking broader fragility in the underlying economy.
That's right.
Portfolio managers see inflation risk and geopolitical chaos, and instead of moving into cash, they crowd into a handful of tech giants because of their perceived absolute return.
Yeah, it makes the S&P 500 look indestructible on the surface, while traditional cyclical sectors are quietly buckling under the pressure of higher borrowing costs.
It's a localized bull market holding up a macro-level house of cards. So we'll take a short breather, and then we'll dive into our corporate events recap and what you need to watch for tomorrow.
Sounds good.
Welcome. Welcome back. Session 3, corporate events recap and what to watch next.
So just after U.S. trading hours concluded, around 4:15 p.m. Eastern Time, Costco released its Q3 earnings.
Costco.
Yep. They reported higher net sales, which provides a really crucial data point for anyone tracking the health of the middle class right now.
Costco is the ultimate macroeconomic shock absorber. We closely monitor retail right now because energy shocks act as a delayed consumer tax.
Right.
When crude oil spikes, it takes a few weeks or months for that pain to bleed into the cost of logistics, groceries, and everyday goods. It effectively drains real disposable income. But Costco's specific membership and bulk pricing model means they actually benefit from a trade-down effect.
Exactly, yeah.
When the middle class feels the squeeze from that delayed tax, they abandon premium retailers and upgrade to Costco to save on a per-unit basis. So strong Costco sales mean the consumer is still surviving, but they're dramatically shifting their behavior to do so.
Shifting from consumer logistics back to macro supply chains, there was a pivotal event earlier in the U.S. session around 12:05 p.m. ET.
Oh, right, Canada.
Yes. Canadian Prime Minister Mark Carney pitched a new U.S.-Canada economic pact, and it focused aggressively on critical minerals and energy.
Which is entirely an AI infrastructure play, just dressed up as traditional trade policy. You can have all the semiconductor chips and coding talent in the world, but if you don't have the baseline power to run gigawatt data centers or the copper to connect them, the entire revolution stalls out.
Yeah.
Carney's pitch addresses energy access as the bottleneck for AI. He is essentially offering a secure North American supply chain to feed the exact physical constraints that threaten to slow down companies like Microsoft and Amazon.
It really highlights how deeply interconnected sovereign policy and corporate capex have become.
Exactly. Well, folks, today was the kind of day where the Fed threatens us with higher rates, inflation comes in hot at 3.8%, and the Strait of Hormuz remains a wild card.
Yeah.
Yet the market simply doesn't care. It seems that as long as Anthropic raises another $65 billion and Amazon secures more AI chips, investors are perfectly happy to blindly buy the dip.
That's true.
If policymakers really want to cool down this tech rally, they might have to ask Microsoft's new coding model to write their next hawkish speech, because the only thing completely artificial today was the early morning sell-off.
That is a dark joke for a very strange day in the markets.
I try.
So looking ahead, here's what you need to watch for in the next 24 hours. Friday, May 29, 2026, at 12:30 p.m. ET, we get the U.S. April goods trade balance, retail inventories excluding autos, and wholesale inventories.
Got it.
Then we have a string of afternoon Fed speakers who will likely react to today's data. Williams at 12:55 p.m., Bowman at 1:10 p.m., and Paulson at 1:04 p.m.
A lot of Fed talk.
Lots of it. Finally, the Chicago PMI drops at 1.45 p.m. ET.
All right, now let's transition to our... two-minute bonus session, paper trading. For our newer listeners, we started this internal experiment back on April 17th, 2026, with a hypothetical $10,000 trading 13 macro ETFs.
Yeah, it's been fun.
It has. The goal is to see how our daily analysis translates into tactical portfolio allocation. The current portfolio value sits at $11,128.03. That is an 11.28% return, nicely outpacing the S&P 500's 6.14% return over the same period.
I'll hand it to you first. What are your moves?
So I'm dumping about 7.5% of our consumer discretionary allocation. XLY is out to the tune of $850, and I'm rotating that capital straight into energy, ticker XLE.
Okay, interesting.
My rationale is that the market is severely mispricing the reality of the Hormuz conflict. We saw physical brinkenship escalate today with the IRGC missile attacks. That virtually guarantees that inflation and energy crunches will continue to act as a delayed consumer tax.
Right.
Meaning retail and discretionary stocks like XLY are going to suffer. Meanwhile, as the Fed fights to maintain credibility, they'll drive up discount rates, further squeezing those consumer cyclicals. So out of consumer discretionary and into energy.
Well, I am completely aligned with your macro read on energy, so I am also buying into XLE, but I am funding it differently.
Okay, hear it.
I'm going to sell roughly 10% of our technology allocation, ticker XLK, which equates to $1,100, and move that $1,100 into energy.
Really? Selling tech?
Yeah.
Yeah.
Our portfolio is currently drifting. We're overexposed to tech, which now makes up nearly 35% of our holdings. And as we discussed earlier, tech capex is currently masking broader economic fragility.
That's a fair point.
If the market suddenly wakes up to the reality of rising discount rates and hawkish Fed policy, those sky-high tech valuations are the most vulnerable assets on the board. I want to lock in some of those gains and move to a physical commodity proxy.
All right, so since we run this as a joint portfolio, we average our moves. Aggregating those strategies, the final decisions to be executed at tomorrow's close, May 29, are buy $975 of energy XLE, sell $550 of tech XLK, and sell $425 of consumer discretionary XLY.
And it's crucial that I restate, this is entirely a live educational experiment and not financial advice. Past performance doesn't guarantee future returns, and this portfolio could experience severe drawdowns at any time. Do not copy these trades.
Always important to remember. To wrap up today's deep dive, I want to leave you with a broader structural thought to ponder.
Lay it on us.
If tech hyperscalers are essentially printing their own economic weather systems through massive capital raises, while sovereign nations simultaneously fire missiles over physical oil choke points, are we rapidly approaching a moment where corporate capex dictates global financial stability more than central bank interest rates ever could?
Oh, that is a huge question. Let us know your thoughts on that and how you navigated today's market chaos down in the comments.